What is the biggest myth about the housing market today?
That Wall Street landlords are buying a lot of homes and preventing homeowners from becoming homeowners. It's actually people that are flipping homes, which are small mom and pop people that are competing with home buyers.
It's my great pleasure to welcome everybody to Buchanan's County Capital Podcast. I'm Robert Brunswick, chairman of Buchanan Street Partners. Couldn't be more excited today to have John Burns, CEO of John Burns Consulting and Research, as my guest. You know, John really doesn't need much of an introduction, as he's very renowned in the housing industry as kind of the go-to individual, the firm that industry leaders turn to as it pertains to kind of making their important decisions about running their business. The firm was founded in 2001. He proudly describes his team of pals, passionate, articulate, likable, and smart colleagues. I love the acronym. We use the same things here at Buchanan, although with different words. And really, they allow their colleagues allow them to kind of navigate the tomorrow of the housing industry by understanding housing demand, supply, affordability, building materials, and design trends, things we're going to talk about today. John is a guy that majored in economics from Stanford, MBA from UCLA, works right around the corner here in Irvine, California. But one of the things I found most interesting about his bio, if you will, was that he's been to home games in all 30 major league stadiums. So I've hit about 20. One of my passions is sports and baseball. So while John and I disagree on our favorite teams, we still have a passion for baseball. So, John, let's get started. Welcome. Thank you for doing this today.
Oh, my pleasure. I'm looking. I may have some questions for you along the way. So,
well, this will be great fun together. A Cal and Stanford guy going at it. There we have it. So, I think just as a frame to get started, if you could maybe describe for our listeners a little bit about your company, services it provides, and the profile of your customers.
Yeah, I started the business in 2001, and actually I really started it a little earlier. Coming out of the S&L crisis, the commercial real estate folks, including people like yourself, were very sophisticated and risk-reward analysis, and when the market's not good, we don't do deals. And I found the residential market was the exact opposite. Just give me some money and I'll build something, I'll make a fortune, and then I'll give it all back to the banks and file bankruptcy. It was a complete mess. Nobody was collecting good data like the commercial real estate market does on residential. So I started a business to help the home builders figure out what was going on in the market and be their outsourced research department. So that's why I started it, and then it morphed into rental housing, and morphed into building products, and morphed into housing industry stocks. We just became the everything housing company. And I don't view us as a data company, although we collect a boatload of data to figure out what's going on in the market. I view us as a company that's trying to help our clients make good decisions the way the commercial real estate folks have been doing it for decades.
Sure. So we started the company in 2001?
Right after 9/11, yep.
After 9/11, amazing. And just to make your customers are really primarily home builders, anything home construction related, so landowners?
It's pretty diversified. So it started out with home builders. They're only about 20 to 25% of our clientele. We have a huge private equity clientele. I mean, the biggest building product companies in the country are clients of ours. When the great financial crisis happened and they were throwing $10,000 tax credits and didn't know what the hell they were doing, I went back to DC and made the rounds there just to educate the policymakers, and came out of that with this idea that single family rental was probably going to be a pretty good play. That was very early. That was February 2009. So when the money loaded up to start buying homes at huge discounts, we became the go-to source to help them figure out where they should be doing it and what's going on in the market. So we have a huge single-family rental business, which morphed into the build-to-rent business, which I'm sure we'll talk about that because I'm really bullish on the long-term opportunities there. And I know a lot of your clients invest in apartments. I'll just say this: shame on the apartment guys for sitting by and letting all these companies build billion-dollar businesses doing what they should have done.
Well, gosh, you're touching upon a number of topics we're going to cover. I can't wait to get into it. So I remember when I was just graduated from Cal and living in the Bay Area. It's the early 1980s. The prime market was I think was 16.5%. And I bought my first house, and I figured so lucky to buy it. But I look back now, so I think about affordability, I think about supply, but maybe just to start us out, what's the most misunderstood aspect of the U.S. housing market today, if you were to just kind of kick this off today?
Oh God, there's so many. I'm sure we'll hit a lot of them. I will say this Road to Housing Act, which really was all about preventing Wall Street from buying homes from homeowners that want to buy them, it's just not true. And so Wall Street was, I mentioned they were doing it when there were the big Tuesday auctions in Atlanta where you could buy thousands of homes for $70,000. So there was a period, but from 2012 to 2015 or 16 where they were doing that, but they weren't competing with homeowners. They were competing with each other. There were no homeowners in the market, home buyers in the market. And then when interest rates fell to zero a couple of years ago, capital around the world basically said, we just want some yield. And if it's backed by an asset in America, we'll take it. So that benefited a lot of commercial real estate and apartments. It benefited the single family rental landlords too. So there were two periods where they were buying a lot of homes. They haven't been buying many homes. In fact, they've been selling more homes than they've been buying them for the last 3 years. But try to convince a politician of that or any of the people online of that, it's just not true.
I would agree with you 100%. I got involved with a company called Waypoint Homes years back. Doug Bryan's a friend, and we actually had him on the podcast. And I agree with you. They had a model which was kind of rent to own. Clearing it ultimately just didn't paper, and because they couldn't get it done, so they had to evolve their model. But again, I'm familiar with this space and would agree with you. How much is rent to own by Wall Street today? What do they own? 2 to 3% of the housing stock?
It depends how you define the housing stock. They own maybe about 3% of the homes in America, but 20% of the homes in America approximately are rented. So they have a very small market share there.
By the average person who has that other 17% is probably they own 2 or 3 homes.
Right. And that's your typical landlord. And I'm sure we'll get into opportunities later, but I think that's where the real opportunity is.
So let's kind of go upstream a little bit and talk about drivers to your world. So I'm thinking about your company, what you're known for, demographic trends. And to me, I think about the unpredictability today of trying to get your arms around demographic trends with the immigration changes, birth rates maybe coming down. So how do you factor these types of things into your go-forward projections as you advise your clients?
Well, you were right. It was so confusing. 10 years ago, we actually wrote a book. We put 7,000 hours of research into it to figure this out. So we wrote a book called Big Shifts Ahead on Demographic Trends. I predicted I was going to be 10 years older then, and here I am. Demographics is very predictable, right? And so it's the slow moving train that's very predictable. But to answer your question, you brought up some societal shifts. So what we learned in the book, there's a framework we call the 456 framework, but there's the 4 things that I think will help your listeners bucket demographics. There's government policy which can impact demographics, and you talked about immigration. So or Fannie and Freddie helping homeowners, so there's those type of things. There's the economy, obviously, which job growth is really what matters more than having children, because that's an additional adult with an income who needs a place to live. And that data is very good by market, fortunately. Technology, and there's some things that I'll mention to you that you don't think of about technology, but like the birth control pill was pretty significant on demographics. Work from home is pretty significant on where people can live, and that's all technology driven. You and I could not have done this podcast online 30 years ago, right? And we're both doing it from our house, it looks like, too. Or I'm in the office, but it's
I'm in the
like
office. We just got a relaxed backdrop.
good. But the fourth one that is the hardest to predict, you brought up, is societal shifts. So you really don't, you can't predict, like, people are going to start having fewer kids. Um, some of the societal shifts are very difficult. And that's the one that when we forecast the future, we usually miss some sort of a trend.
Well, I think about immigration, which is the easy one to maybe look at. And we're an owner of Class A apartments, and it really hasn't affected dramatically that, although B's and C's it has. So I'm sure you're to project out, who's in office, what's their immigration policy is hard to do. But certainly there's been a decline of some absorption based upon that fact.
Yeah, so we have two full-time demographers, and we have studied this ad nauseum. So I think there's some very underreported things here. So first of all, 2022, 23, 24, we had the highest immigration into America ever by a long shot, greater than the 1920s, by a ton, which you're right, ended up in B and C apartments. And all of my Class A clients are like, well, they didn't rent from us. Well, when they fill up all the B's and C's and rents go up in the B's and C's, guess what? A lot of the better qualified B tenants end up in A's. So it hugely impacted, in my belief, the multifamily market. I think it actually bailed out the multifamily market, which I know is struggling right now. But believe me, if we had not seen that immigration, multifamily would be in much worse shape today than it currently is. We saw like 15% rent growth in Dallas one year. I mean, good God.
We own apartments in Dallas, and that rent growth is certainly not 15% today.
No, it's not. But to your point, there's one other very important point, and I think we keep talking about it as if it's America's decision on whether or not we let these folks in, and that is part of it. But there was not a policy shift that allowed all those immigrants to come in. It was crap going on around the rest of the world. It was China locking down once again. It was the Russia-Ukraine war. It was Cubans able to get out through Nicaragua all of a sudden and find their way up through here. It was the crisis in Venezuela that caused middle class and middle upper class people to get the hell out because they were afraid for their lives. We did the study by where these people were coming from. It was not so much people coming across the border from Mexico. They may have been coming across from Mexico, but from Venezuela and Nicaragua. Those things drove immigration in America, and that slowed down a little bit. And our policy has become very restrictive. So you're right. There is virtually no immigration right now. It's the lowest immigration since the 1950s, which I had to what was going on in the 50s? It was the McCarthy communist era where we didn't want to let anyone in the country because they were communists. So that's how low the immigration is right now.
And just to touch quickly on population, because look at people are getting married later. They're choosing not to have kids. That has impacts to population. So that's a big driver in the housing space.
No, it is. And it's created a lot of pent-up demand, I think, for housing. It's been a huge beneficiary to the rental market because people are renting longer. And I think it's helped everybody charge higher rents because I've got a 33-year-old in my apartment complex and they're making more money than when they were 26, so they can afford some more.
Yes. Well, everybody just slower starts to getting on with life. But I got to get to the paradigm now. So we keep talking about housing slowdown driven by affordability, but there's consumer trends that change. But I keep thinking there's a paradigm shift, and I know you've written about this to the counter of my intuition. My intuition was maybe the paradigm shift's changing, and the dream of owning an American home isn't so important anymore, and the rental options are so great that people want to move around and they want to have different rental options and not be tied down to that mortgage in that home. But you're going to maybe disagree with me and tell me that everybody still does want to own a home.
Well, I tend to disagree with people on that because they're overreacting. So I'll say I'll agree with you, but I don't think it's as permanent as it comes across. So when we've studied the generations, the timing was different, but by the age of 60, every cohort got to 80% home ownership. Maybe this one will get to 75 or something. Maybe it'll be less, but it's not like we're going to have 25% homeowners at the age of 60. It's not going to change that much. And there's some things involved here. So first of all, the great foreclosure crisis left a stain in a lot of older people's mouths about home ownership isn't always great. Home prices don't always go up. Maybe I never want to rent again, or maybe I never want to own again, and I'll just rent. So our build to rent clients are selling a lot of homes, are renting a lot of homes to people who are selling their house and downsizing and renting by choice. So I think that is something that's going on later in life. So there is a trend there, but it's not like half of the baby boomers are doing that. It's a slight increase in my view. And then I think younger folks, this is more of a short-term thing. So if you think of the last 3 years, well, all the money I put into the stock market has doubled, and my rent's not growing. So why would I buy a house? But do you think the stock market's going to double every 3 or 4 years, and you're never going to get a rent increase? I think the biggest impetus for people to go become homeowners is 3 or 4 years in a row of pretty significant rent hikes. And they're like, I'm not going to move anymore. And then we need to settle down. We want to be in the right school district. And that's another thing. Getting in the right school district, you used to have to be a homeowner. Now with this single family rental trend, you can actually rent in the right school district from a landlord that you can trust is not going to sell the house out from under you, and you're going to have to be moving every 2 or 3 years. And you mentioned Doug Bryan earlier at Waypoint. That was some of the early things that Doug and Colin figured out. That's an opportunity. And I think this opportunity to rent is going to contribute to lower home ownership too, to rent for somebody reliable.
Let's move to the supply side, because every day you read we're structurally undersupplied in housing. Has this become an overstated kind of narrative, if you will, this undersupplied? Was it just in pockets and we hear about it because we're here in California? So kind of open that up for us.
Well, it is very local, but if you roll up the whole country, our view is we're undersupplied by 1.1 million homes. And there's all sorts of assumptions that go into this. I'll tell you, I've vetted the ones that are saying 4 or 5 million. I think our 1.1 million is right. You understand vacancy rates, and when vacancy is higher or normal or lower than normal. I mean, vacancy is lower than normal by about 1 million units in the country right now. So just to get back to a normal vacancy, we'd need about 1 million more units. That's the way we look at it. Some of these bigger things are more, they make assumptions like we never overbuilt the market in the early 2000s, but we did. That the demographic growth in America is the same as it has always been, but it's not. So but the bottom line is 1 million units is still a lot of units.
So what did I read? I read something like a healthy supply level is 5 to 6 months worth of inventory, and we're at 4.5 months now. So it just seems on the margin so insignificant, but I guess as a percentage, it's fairly significant. So we are undersupplied right now.
Yeah, but the people that say that, I very much disagree with them on that. And that's one of the technology shifts. So when you wanted to buy a house, when you bought your first house, you had to look something up in the newspaper. You had to go to an open house. It took forever. Now you can decide to buy something, find something online this afternoon and get a bid in tomorrow. So homes don't stay on the market as long as they used to. The 6 months is the old rule of thumb. I actually think the new healthy rule of thumb is about 3. And I can prove it because there were times, like Sacramento for a while had 2 months of supply on the market and home prices were flat. So you can't tell me there was undersupplied. That would mean home prices would be going up.
So part of this undersupply is impacting affordability, of course. And that is another benefit to getting that, let's call it 1.1 million of shortage of homes get on the market to kind of stabilize pricing or provide more options on the affordability spectrum.
Yeah, well, that's the other part of it, is that if you put them all on the market right now, the demand is for lower rent and lower prices. So the market did adjust for the undersupply. I mean, we were very undersupplied early in COVID, and we saw a lot of rent growth and a lot of home price appreciation, and that's the cause of the affordability problem. It happened then.
So, John, you opened up in some of your earlier remarks about this single family rental space, and you said it's been a good thing for our housing industry, and I happen to agree with that. And how influential has it really been? Because we talked about it being 3%, but is 3 maybe going to turn into, well, you said 17% if you include ma and pa that might own a home that they're renting to somebody. So talk about the housing ecosystem and the influence of single family rental and the importance it's brought to bear.
Yeah, well, this Road to Housing Act did make it difficult for large companies to buy scattered homes around the country. So there's some legislation that's getting in the way of this. But you and I have been in this industry for a long time. The apartment market was full of all mom and pops 40 years ago, and look at it now. And and the big companies have a huge competitive advantage. The tenant, they market well. The tenant can say, okay, is this company a good landlord or a bad landlord? When I first rented, we had no idea. We couldn't do any of those sorts of things. There's now, if something's broken, I can get on a call center and call somebody, and they can help me fix it. I mean, I think we take that for granted in the apartment market right now. That's just emerging in the single family rental business. We do tenant surveys. In fact, we just finished one on the build to rent tenants, 7,000 tenants. They love living in these communities. Why? Because I want a yard. I want a garage. I don't want somebody walking on my ceiling. I've got a pet. And you know what? When I'm renting a house, my neighbors look at me like I'm the deadbeat. And now I'm with a bunch of other renters, and you're building a community that I can actually vet. It's a brand new house, so it does target more affluent people because it's more expensive because it's brand new. That's the message I don't think has gotten out, is how much the tenants love this and how little of this there is around the country for people who want a yard and a garage.
John, let's get into the weeds just a bit, just to be clear for our listeners. A Wall Street landlord can't own, once you get up to 350, you're done in terms of your ability to scale. Is that what the new law tells us? And you got to also, unless you go to rent to own, which gives some latitude to that because it allows that landlord to say, I'm actually providing ultimate housing stock for people that want to buy.
They've permitted consolidation in the industry. So if I own 500 homes, I could sell it to somebody else, so some of them can still grow. You're right; they can get around the rules with rent to own. But my experience has been, we've had a bunch of clients that have tried that. Renters never exercise the option to own, so it'll really be a way to get around. It won't really create more homeowners. But they can, and they tried to stop this for a while, which would have been a huge mistake. But now we can build rental homes and sell them to these big single-family rental companies. That's allowed. Thank God. I mean, otherwise we'd have even more of a supply shortage.
Let's talk about the multifamily space. Unlike for sale single-family housing, multifamily seem to get overbuilt in markets, which has caused some of the stagnation of rental growth and the challenges with maybe valuation because of that lack of rental growth. So help correlate for sale housing and multifamily and the correlation to demand, because I assume it's within the same housing stock. So just color that a little bit if you could.
Yeah, I've got some good charts on this too. I mean, there's been years when the economy's been strong, when almost all the household formation went into rental and almost all into for sale. So they don't they cycle back and forth. But I've got a kind of question for you that can help me answer this. So when interest rates went to zero, the money interested in getting into apartments was just insane, right? Yeah. And the yields got very low. And so people want a higher yield, said, well, let's do some development. I would like to know how many shovel ready projects there are around the country right now that are entitled and just don't have their equity source.
Yeah, we supply construction financing for ground up apartments. That's one of our verticals. We own apartments. We don't provide equity to joint ventures, but just in terms of hearing it out in the marketplace, there's not a lot of equity available because the yields on a unlevered stabilization return on cost aren't very interesting to what the ultimate cap rate exit would be.
Right. But is there more than usual people looking for that equity because they have a project that's my point. There was a ton of money that came into the market, and a lot of the projects got developed, and then a lot of projects are on the sidelines, exactly as you just said. I think as soon as deals start to pencil, we could see quite a bit of construction over the next few years. And that's what we're trying to figure out is how many multifamily starts are we going to see? Because we do a lot of feasibility work. We do about 1,000 feasibility studies a year for sale and for rent. Like, our business is down, but the extent we have a good business, it's on deals people tied up 2 or 3 years ago. Like, nobody's tying up new land projects for the last 24 months.
To me, the equation there is always what is the unlevered return on cost on a stabilized basis versus the exit cap. And until that math works, and people got to be, and most equity investors are smart enough to really understand a stabilized return on cost versus a trended, hoping for rent growth, stabilized return on cost. So I think we're on the same page in that regard. That will be. It'll be a while. I think there's a bit of absorption that needs to take place. Now it depends on where the market is and what's going on in that particular supply demand market. But good prompt, and obviously you're attending to that. So let's get into some projections of. You're so good with your book you wrote, The Big Shifts, in 2016. Is that when you wrote that?
Yes.
I mean, you nailed it. Rise of suburban living. Suburban. I love how you coined suburban living. Mass migration to the Sun Belt. Changing housing preferences to the rental boom. The shift in work and active retirement. Kind of building communities based upon generational consumer demand preferences. So now let's look forward to the next chapter of your book or the next book and project out some things that we can think about that help us understand maybe product style, geography. You hear about workforce housing. Give us some vision.
Yeah. Well, there's a lot in there. I wish I kind of had a bullet point list on all of them. So one of them is, and it is related to this work from home trend, is people are more like, and you mentioned the term suburban, which was like urban-like living in the suburbs. It's even more than when we wrote the book, and it's even more exurban. So if I can get more for my money further out and I only have to commute 3 days a week, or I don't need to commute at all, I will do that. And you know what? I won't even go to the major metro area. I'll go to Greenville, South Carolina. We're seeing a lot of growth in these very small markets, but not so much growth that they need 1,000 units a year of apartments. Maybe they need 500 and they used to need 200. The growth has shifted that way. The other thing that you talked about was multi-generational living. So there was a trend and there still is a trend with adults and living with their parents. What is going on now is, and I'll make fun of my generation, we were helicopter parents. So we helicoptered our kids. Now that our kids are adults, we're still helicoptering them. And so Del Webb started Del Webb Retirement Communities under the survey, where he found out that people, when they retired, they wanted to get away from their families, like literally, like, I raised my families, I'm going to Phoenix and Florida, I'm going to play some golf. Now the number one amenity of this generation is to be near my kids and grandkids. So you're finding people retiring in places they never retired before, like a Dallas, because that's where the kids and grandkids are. And so there is a lot of opportunity to target affluent, older people who maybe aren't sure they're going to like Dallas and want to rent. But if they're coming out of a house, they probably don't want to rent an apartment. They probably want to rent a house. and so this build to rent trend is perfectly set up for them. And it doesn't have to be a detached house. It could be a paired townhome with a driveway and a garage and a place for the dog to take a leak. That is a huge trend. And that's one of the societal shifts that we had not really thought about when we wrote the book, but it is playing out in a massive way. Master planned communities around the country, we were trying to get them to do build to rent 5-6 years ago. They're like, we're not going to put rental homes in our community. That'll destroy the reputation of our master plan. Now, Lakewood Ranch has 7 of them. So now they've said, you know what? This is awesome because we're renting the house to the grandparents. Their kids are buying down the street. They've got the babysitting going. And then, if they really like it here, then they end up becoming homeowners. And then also on the flip side is people maybe want to test drive the community for a while. So let me rent in here for a while. I'll rent in the build to rent. And it becomes a feeding ground for people to buy homes in the master plan. So that's been a big change. And there was none of that 10 years ago.
So the age, go back to demographics, the aging of America, and that's got to have some impact to what you just said. That's huge. So that's a whole nother product class where you just kind of got into that is available for these builders to think about for that generation's demand, the boomer demand of the next chapter.
And boomers do not want to rent on the second story of a garden apartment complex. You need to design something differently.
So I want to go back to the federal housing. What do we? They call it the 21st. I wrote it somewhere. 21st Century Road to Housing Act, which has been positioned as a bipartisanly hands joined consensus to unlock the supply issues. I guess by reducing federal red tape, by leveling the buying, reducing the Wall Street buying as a competitive buyer, which we talked about, and maybe mobilize banking capital so that the Reinvestment Act enhances that. So is this just sound good politically, but it's not going to have much impact? Or do you think this could move the needle for improved housing supply?
Sounds good politically. It's not going to have much impact.
Got it. Okay. So moving to governmental policy, let's talk about California. You and I live here. We see it. So how is California going to bring new supply online in a thoughtful way? I assume we need it. We got lots of issues here. So what's the biggest obstacle in the way of getting more units built here in California, and how do we solve it?
It's local municipalities. And so that's why the federal legislation is meaningless, because all the challenges are local. And, Newsom has been suing cities for not building enough housing in California. And I think he's been winning too, but the cities say, I don't give a damn. I mean, you're not going to tell me what to do. There are, I don't have the exact numbers, but they did allow accessory dwelling units to get built and override city objections. We've seen a surge in housing and accessory dwelling units. The data on that is not very good, but we've seen a lot of that. And then, this work from home has enabled more people to go to outlying areas, and that's where there's land. So that's where you can build more. But, you can't build more in LA. All the land is taken. I mean, that's just, I don't know, but it's not a construction that's going to solve the problem there. It's just a highly desirable place to live with very little supply. And so that's the problem.
I wonder, are these cities woefully understaffed with talent that can really process and move these things along thoughtfully? And is that a leg of the stool that we're not talking about?
Um, I say the answer to that is yes, but I don't see most cities seeing that as a problem because the people that elect the people to the city council tend to already own their home. They don't want to see more traffic. It's pretty hard to get reelected on a pro development policy in California.
Yeah, the NIMBY mindset, exactly. So, as I think about the home, we're a multifamily owner at Buchanan Street. So as I think about the less attainability of home ownership, when does this translate into stronger apartment occupancy and rent growth? Is that market by market, or how do you kind of triangulate that?
Well, there's a couple things. So on the demand side, I mean, you're actually doing better than you think because very few people are buying homes right now. So your biggest competitor in an apartment complex is home ownership, and people are not buying homes. And I don't think the apartment market's talking about that enough. That's where we come in. Frankly, is like when that shift happens, we'll be able to tell our apartment clients, and we're telling them to pro forma normal turnover is going to return, and everybody's got subnormal turnover right now. Um, and then the other when is rent growth going to return? We need job growth. Everybody knows that. What the issue is so many people are retiring is we don't have much job growth. The last time I looked, we had something like 4.2 million people entering the workforce every year and 4 million people retiring every year. So it's really hard to grow housing demand when that many people are retiring. Now, when you retire, you still need a place to live, so it's a little more complicated than that. But we are in a permanently lower employment growth situation purely due to our demographics. And we're not unique. This is the case in almost every country in the world right now.
Yeah, a lot of variables that go into your counsel that you provide your clients. So I'm getting a greater appreciation for it. So your client, I'm sure you've had this question daily asked of you, and that's the counsel you provide. But if you were allocating capital today to the space, um, what housing related sectors and then maybe geographies might you steer your client to as you think about kind of that allocation and that bet?
It's all the places they don't want to go. So everybody wants to be in the big growth markets in the Sun Belt. And you know what? There's too many of you that want that. So everyone wants me to say Dallas and Phoenix so their project will pencil. But I think there's more, we were talking about this earlier, more shovel-ready projects in those markets than there is demand. And that's going to be the case for some time. These smaller markets are where you're more likely to have success, but that's not in your backyard. That's a long drive or a plane ride. People just want to go there. So the people in these smaller markets, I mean, if somebody from a smaller market brings you a deal, I would look at that.
John, I agree with you. It's hard to do that because as an operator looking for efficiency, you want to say, I want to amass a certain amount of unit count to make this justifiable for my trips, for my conversancy in that market. But help me understand when you say smaller market, there's primary, secondary, and tertiary. So
Yeah. So Phoenix, Tucson, Prescott. It's probably more Prescott. And nobody wants to go to Prescott. And the other thing you're talking about, Robert, is there's so little capital interested in going to Prescott is that the exit cap rate is higher. So it's hard. You don't have as many. You wouldn't have as many people bidding on your project either.
right,
So
that's the conundrum. You might like going in. You like your going in cap rate. You just don't like your coming out cap rate.
well, but so we need more people in this country who think long term and not flip. And the industry, the private equity monies are all 5 to 7 years, and But somebody who's going to build to own, and we do have a number of clients that do that. They're big owners at this point. They've been doing it for decades. They're the ones that can see this through. The other thing is that I would just be patient on this. But I think if you want to start a business and be really successful over the next couple of years, couple decades, it's build to rent. Now, that does not pencil very easily right now because they have some of the same overbuilding problems and the lack of rent growth problems. But we just had we have an annual virtual summit we call it the Rental Community Summit, but it's really about build to rent. The guys that have been doing this shared how they've learned some lessons and they've pivoted the product for what the consumers want. And I think the demographic demand is going to be massive. And there's 12 million renters of single family homes in America right now. And very few of them can rent from a landlord that they've heard about and rent something new and rent with other tenants and rent a home that was designed for renters. This is the same opportunity that happened in the apartment market 4 decades ago that nobody thought you could do and this is technology too. Technology has allowed people to manage these communities much simpler than you could have 20 years ago because you can get the leasing done online. You can call the maintenance guy, and guess what? The maintenance guy can give you instructions, or now it's even a bot can give you instructions on how to fix the toilet or whatever needs to be fixed. And you don't need people on site like you would have 20 years ago to get things done. It's a huge opportunity, and I believe these big companies, some of the biggest apartment companies, have been dabbling in it, and I think you know what they've learned is that's some segmentation in a big community. So if I've got a big parcel and I was going to do 300 garden apartments, why not do 250 garden apartments and another 40 of these, and I'll lease up faster because it's a different tenant you're attracting.
So they're adding horizontal development to their platform of vertical. Got it.
It's an additional tenant segment that they've been completely ignoring their entire lives.
Great vision. I want to go back just briefly. You said Phoenix, Tucson, Prescott. So can you give me two other Tucson, Prescott examples?
If you just go to Atlanta, it's the outer rings in Atlanta. Atlanta, you can go down to the Birmingham. There's big job growth in Huntsville. With words out on that, there's been plenty of supply in Huntsville. But it's not these markets where you can get a straight shot flight in from LA necessarily and count on 20,000 jobs this year.
Is it a Boise? Is it a Bend, Oregon?
I like Boise a lot. Boise tends to cycle pretty hard because it tends to be pretty tied to the tech industry in Silicon Valley, and there's a lot of supply there. But I do think 20 years from now, we'll look back on Boise and it'll feel a lot like kind of a hybrid between Denver and Salt Lake.
So this is so informative and interesting. If you were to kind of project out, you are this guy, so it's easy for me to ask this question. What kind of housing related prediction do you think investors wish they would have acted on today? That you've kind of colored it, but more specifically, what would you focus on?
There's not a lot of things that pencil today. So I would just get really smart on these smaller markets and build to rent, and by studying the product and studying the tenants.
Well, that makes sense. The back to basics, as we say. I know that's kind of our view around here at Buchanan with our own investing. John, we could go on and on. There's lots of information that you've provided. You've touched a couple of topics, but I want to be mindful for your time. We absolutely are going to have you come back on our podcast. The takeaways you've provided, the vision, the work you've already done. I would highly recommend to all of our listeners to pick up your demo. So you have a new book out, or do you have a new?
No, I haven't got committed to doing another 7,000 hours of research. That was plenty.
But you're always doing research, and I know So for the average listener, is that research that they can get access to, or is that stuff primarily for clients that sign up for some more organized program?
Yeah, we have membership subscriptions. Other than we have a few cheaper ones that are maybe 12 grand a year. Most of them are around 40 or 50. So we have bigger clients. We do publish a lot for free with our newsletter and on LinkedIn. So if people just want to hang around the hoop, we give a lot away for free there. And our consulting team, which is all over the country, we have local people in all the major markets. And going back to my comment earlier, we did feasibility studies in 130 MSAs last year. We'd never been in that many MSAs. That's a great example of how the small markets are strong. If you've got a project that you need somebody to really validate the assumptions on, I think we're phenomenal at that.
So, John, I always ask the guests that I have on this. I'm sure you're like me. You mentored lots of young people. You see lots of young people coming through the system and wanting to have a career in real estate. When you and I started, the path wasn't as clear because it was still a cowboys and Indians business. But what advice might you give to a young person thinking about starting their career in the real estate business as they think about, their dreams?
And I've got a 26-year-old daughter who's in it too. So, and a whole bunch of employees. What I encourage them to do is just get out there more and build more relationships. And the only thing that really sticks with them, because they're so stuck on their phones and, the poor ones that went through COVID and things. But just the analogy I use is, look, all the friends you made in high school and all the friends you made in college, it's now time to make those friends in the industry. So just look at it. This is not work to go to a ULI meeting. This is a chance to go to an event with a bunch of people that have common interests in you and make some friends. And you know what? You'll learn a lot from them. And those are the people you do deals with over the decades.
I applaud your answer. The AI world that we're in, I can't tell you how many cold calls I get, or they think warm calls, by emails. I mean, as much as I like to be thoughtful and return emails, at the end of the day, I say, this person did no research on me. I have no interest in why don't they pick up the phone and call me or show up with a donut and let's have a conversation?
My hot button is my employees say this to me all the time. I talked to so-and-so, and I said, did you talk to them? Or were you typing to them? Because there is a big difference, and it's usually typing.
Well, that's wonderful. Well, thank you again. I appreciate everybody joining in for another round of our Accounting Capital podcast. John Burns did not disappoint. We're going to have him back. So many perspectives and insights. I encourage you to tune into his LinkedIn and listen to his continued observations about the housing market. Thank you very much, John.
Thank you for joining us on this episode of the Accounting Capital podcast. For informational purposes only, and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.